Ask yourself, how many of your biggest losses came from entries where you sized too big too soon, before the market showed any real agreement with your view? Turning small trades into big winners comes from alignment with the market, not aggressive sizing, and most traders misunderstand this at a very fundamental level. It rewards alignment, timing, patience, and the ability to recognize when a trend is developing in your favor. A small position that grows naturally because the market is inviting you in will always outperform a large position forced into a setup that hasn't proven itself. Alignment is about moving with the tape instead of fighting it. It's the difference between pushing your opinion and letting the price do the talking. When a trader is aligned, he's not predicting, he's observing. He's watching how the stock behaves around key levels, how it responds to pressure, how it acts during pullbacks and breakouts. The small trade becomes a tool for reading these behaviors. If the market confirms your idea, that small trade starts to work. If not, the loss stays manageable. Ask yourself, how many of your biggest losses came from entries where you sized too big too soon, before the market showed any real agreement with your view? The way a small trade moves in the early stages tells you almost everything you need to know. When it aligns with the market, it moves quickly, cleanly, and without hesitation. The tape feels cooperative. The price respects support, rejects dips, pushes through resistance with purpose. This behavior is the market saying, you're on the right side. And that's when scaling makes sense. Not because you want the trade to work, but because the market is already showing that it is working.